Morning and welcome to another edition of the Main Management Weekly Market Note for the week and month into July 31st, 2026. Hard to believe we are already into August. On the performing side, we're still seeing, kind of this shakeout a little bit, some uncertainty. Things really ripped in the month on Friday, up big, but I think the week leading into it were a bit more kind of net negative versus positive. You can see on the right there, the sectors were pretty split, 4 higher, 6, 7 lower. And then on the left, the broad indices were more up and down. Commodities down 2 on the week, a lot of that on the oil. And then year to date, energy leading the way up 33 and comm services down the most at 8.1 for the sector dispersion. Recession dashboard, not a ton changed in July. I'm still kind of looking at that inflation running hot. We get a little bit into that here. The FOMC was, the kind of the bigger news of the week. They left rates unchanged. They did have 3 dissents in favor of a 25 basis point hike. The statement and the press conference were kind of a little contradictory almost. In that the statement was definitely more hawkish. They said, activity is spending at a solid pace, productivity growth, capital investment are strong, and unemployment rate remains relatively unchanged. Inflation still elevated, and emphasize that the committee will deliver price stability. That kind of speaks to us and says they want to get back to that 2% target. We haven't been at 2% since 2022, basically. And so they're definitely, the statement said we're clearly committed to the price side of the dual mandate. But Warsh was out there in the press conference and kind of suggested that maybe policy would be a little less tied to data points, which is interesting because Powell was really very, data dependent. We are going to wait and see what the data says. So I think markets were a little confused by that.
And there were 3 dissenters as well that were in favor of a hike at this last meeting. I think there was some fear going into it that there was going to be some surprise hike. Thankfully that didn't happen. But as you see on the slide here, there's still kind of 1 to 2 hikes priced in through the end of the year, which we will see kind of depending on, I guess, the data and lack of data, according to Warsh.
So we'll see. We'll see what they do, I guess. More wait and see for the time being. Core PCE, which was Powell's stated preferred inflation measure. Warsh might view, he's looking at like a 3-month annualized or super core or something like that, a little different. But anyways, core PCE up a muted 0.13% month over month in June, below forecast for a spot 2 rise, smallest since March of 2025. And then on a year-over-year basis, it decelerated to basically 3.3, call it. Again, it's still well above its target. We haven't been below that since Feb of 2021. The broader PCE price index, so not core, this is broad, including everything actually deflationary, was down 0.11% month over month as energy prices fell 6%. Year-over-year figure down to 3.67. And that's the first kind of decline, since April of 2020, basically on the month over month figure. You can see it goes ways back. So that's, we don't think this is going to a trend starting. It's more likely that things will rebound in the July reading that we get at the end of August. But I think, it's inflation's running hot and the Fed is clearly focused on it. The nice thing is the labor market so far has been pretty solid. We get a lot of labor data this week. So we'll see, hopefully that continues to kind of chug along. Looking under the covers of that PCE, the consumer spending was up 0.3 month over month, slowing from May's upwardly revised 0.85% figure. Year-over-year slowed to 6.3. But again, it kind of feels like it's just chugging along here, flattening, maybe starting to pick up a little bit. In June, you had FIFA, the World Cup, as well as that Prime Day that was earlier than usual, which helped the spending figure there. And then incomes were up a muted 0.2% month over month, slowing from May's big 0.7 rise, below forecast for a 0.3 increase. They're a little change year over year at 3.92. Back above inflation after kind of that dip there off of some stronger readings. So good to see that, it's back above inflation for the time being. On the GDP side, we got the advanced or first estimate of Q2 GDP. It came in at 1.5, missing forecast for a 2.1 reading. But under the covers, this is a lot more positive than negative. I think folks were kind of like, oh, it missed. And a big part of it was net trade and actually imports. Export growth slowed a bit while import growth remained strong. That means to us, that says there's strong underlying demand. On the right, you can see final sales to private domestic purchasers, which jumped 394 quarter over quarter annualized, the biggest since Q1 of 23. And that encompasses, both consumer spending and investment. So it's a nice kind of broader demand gauge.
Yeah.
And that thing was strong, and it was boosted by, 6.8% jump in goods spending as well.
One of the things that Boris mentioned, it's not on the slide, is productivity and how that's going to tie into so GDP. Obviously, that's one side of the equation. Basically, like how many people do you have and how much output can you get per person? We've talked about before that labor supply, so like the amount of people working has been kind of limited. So hopefully we're getting more of the uplift from the output per person, essentially productivity.
Yeah.
You haven't seen that really show up yet in the data.
We do get a productivity reading this week. Advance kind of prelim Q1 or Q2 productivity figure. So we'll see what that comes in at. But to your point, it hasn't really materialized kind of in the way we would have hoped. We'd predicted even, in, I guess, early is a lot like being wrong. But you're still waiting for this to kind of start to show up.
I think a lot of it, if you look at productivity like AI or wherever you're getting it, it just takes time for that to be kind of diffused throughout the economy.
And it's also a hard thing to measure where you're like, what is a unit of productivity? Is it like 100 emails? It creates a unit? Like, how does that work on the measurement side of just output? But you're like, how do you measure output per unit of time?
It's like a one residual in the equation of GDP. So it's kind of a very rough figure. Longer term, it's been moving up, but quarter to quarter can be noisy.
Volatile for sure. On the consumer spending side, as we mentioned, it rebounded to 3.16% following a relatively weak Q1. So good to see that kind of coming back to play on the spending side. Some of that's due to, dollar amounts being more spending on energy, but it's also indicative of kind of a U.S. consumer that just still refuses to cut spending, even as inflation's been hot. The GDP deflator, you saw this on the inflation side, popped 6.3 quarter over quarter, most since Q2 of 2022. And then, on the other side, the core PCE figure for Q2 slowed in Q1, which is, clearly that diversion is thanks to the exclusion versus inclusion of energy prices in core versus headline inflation figures. On the durable goods orders, modest gains in June, durable goods 0.3. They did solidly miss forecasts, but these have kind of been plugging along on the year over year. More importantly, you can see, ex transports and the core capital goods were up a solid. Core capital goods up a solid 0.9, beating expectations. But transports were the weight on that one. You can see on the right there, that long-term kind of acceleration in the year-over-year trend still remains very much intact. Core capital goods are now at 12.5 year-over-year, most of August of 2021. And next transports are also up 11%, call it, similar multi-year highs on the year-over-year figure. So that's good to see on the durable goods side. On the goods trade balance, that narrowed a bit. The deficit is now a negative 101.5 billion, as both imports and exports kind of declined. Still, goods imports on the right in orange are up 16.6% year over year, so most since March of 25, when we had that big tariff pull forward. And exports are also up 14.8% year over year, both solid gains there. On the categories, a lot of kind of deceleration on the month over month basis, but year over year figures continue to trend higher. Goods ex autos are most at 37.4, and then total goods up 16.6, as we mentioned. You've only got two in the red, which are consumer goods and food, feed, and beverages negative on a year-over-year basis. So again, solid growth shows that people are still buying, indicative of good demand. Home prices, again, these just continue to be high. You see on the left, the month over month, they were down 2 out of the last 3 months, but then now they, posted their strongest gains in a couple of months here. So, it's kind of reflective of, this was in May, so it's several months behind. But, it's kind of the strength you see in the spring buying season. So that's not much of a surprise here. And then on absolute basis, you can see both of those are kind of back to, high, historically elevated. FHFA is at a new all-time high, and the S&P Case-Shiller 20 is just barely below its all-time high, and they're up. They're starting to turn on a year-over-year basis. They've been slowing, now they're kind of turning on a year-over-year basis. So, still no signs of respite here for the housing market on the pricing side of things. And then on the consumer sentiment side, there's just a little bit mixed this month. On the left, we have the Conference Board Consumer Confidence that ticked down to 90.8, missing forecast for 92. Present situation fell to 114.9. It's low since February 21, actually. Expectations were unchanged at 74.7. Under the covers there, that labor market differential, which is jobs plentiful, less jobs hard to get, fell to 3.1. More plentiful, less hard to get. But that thing has been a big kind of staircase, and it's been slowly stepping down, remoderating. The long-term median is minus 4.5. So we're not even, back in honestly the right side of the plus minus zero line, called the Mason-Dixon line, to get back to it. And then on the Michigan, the consumer sentiment, the final reading was revised up to 55.2 from 54.0, the best since pre kind of Iran back in February. Expectations revised up as well to 55.4, while president's situation was revised down slightly lower. But again, maybe sentiment starting to crawl out of the gutter here from those kind of record lows we saw on the Iran, news when that kind of initially broke. But again, it is kind of the on again, off again nature of this, where we just saw another call off on the strike.
Yeah, that's what I've been seeing on the University of Michigan. It's so sensitive to inflation that one week the war is fought, the oil prices have dropped, and then the next week it's the reverse. So it's kind of so dependent on when exactly the people are surveyed.
Totally.
As the war kind of continues to drone on, so to speak, you kind of expect sentiment to continue just kind of chop sideways.
Yeah. I mean, that's kind of the big, the high and the low of it for the week. But, to recap, that FOMC left rates unchanged. Presser versus statement was a little mixed. But I think, markets are calling for 1 to 2 hikes for the rest of the year. Core PCE up a muted 0.13 month over month in June, slowing to 3.3 year over year. GDP up 1.5. Solid under the covers. A lot of that was due to, again, the math and the net trade being a drag. Durable goods orders posted solid gains, slightly below forecast, but year over year figures continue to run very strong. Goods trade balance narrowed a bit as both imports and exports declined in June. Home prices remain high, rebounded from their dip in May, kind of on that seasonal strength. And then sentiment remains muted and relatively mixed for the time being. This week is a lot of heavy. We get the PMIs, both manufacturing, construction, and services. And then we also get a lot of employment data with JOLTS, job cuts, non-farm payrolls, ADP payrolls, and we get Q2 productivity as well. So that kind of wraps it up for the week. Thanks for joining us as usual, and we'll talk to you soon.
Thank you.